Many economists are predicting a soft landing for the world's largest economy. But what does that even mean? And how can you position yourself to benefit from it?
We think about it from a very, very visual perspective. Landing means that you're coming down from something, right? And I guess, what we're coming down from is a very, very high level of interest rates and what it does to the economy. And now, as we all know, the US economy and other developed markets economy have been fighting inflation for the last 2.5 years or so. And interest rates are raised globally to levels that haven't been seen for a long time. And the worry now that the market has is that when the Fed has raised interest rates in such a short period of time, is that going to lead to a significant deceleration in the economy? And when the economy actually decelerates and when interest rates do start coming down, is it a very, very dramatic slowdown of the economy, which triggers a recession, in which case it's a hard landing? Or is it a softer landing where, things, yes, they slow down a little bit, which allows the Fed to start cutting, but it's not as bad as in a recession.
You get, stable growth levels. You get a somewhat of a softer labor market picture. You have unemployment rate going up, but it's not going up drastically. You don't have job losses everywhere around. So it's basically characterized by somewhat slower activity levels, both on the labor market side, but as well as on the business side, somewhat slower consumer spending as well. But like I said, not a complete break on all your spending as well.
Encouraging signs out of the US have led economists to believe a soft landing is in sight.
If you look at the latest CPI number or the Fed's preferred kind of PCE numbers, those are in the range of 2 to 3%. And remember, the Fed's target is actually 2%. And just, I guess, as close as about a year ago, we were looking at a number which is much, much higher, right? We're looking at a labor market that is slowing down, but it's still, from a historical context, employment is still very, very low.
With the Fed poised to begin cutting interest rates in such a scenario, investors say it's time to put spare cash to harder work by reducing allocations to cash and cash equivalents in favor of higher risk assets like equities. Cyclical sectors like manufacturing, industrials, and consumer staples are expected to do well. The tech sector's rally is also expected to continue.
Now, if investors are looking to position for a soft landing, I think some of the sectors that potentially do better in that scenario is that, as you would expect, consumer spending stays somewhat okay, it does not collapse. So consumer staples, sectors like, that sell consumer products, that can do still okay. Even the tech sector, that has obviously been a big focus for investors. I think the spending there on their AI projects and the likes could continue. And that means the tech sector could also continue to justify its valuations.
The S&P is almost at kind of all-time high. A lot of people are questioning whether it's too late to get into equities. And I think it's important to kind of look under the hood of what's driving the S&P higher. Mostly has been dominated by big caps and specifically, the Max 7, right? That's the few tech stocks that have been related to AI that were driving kind of index performance higher. It's called S&P 500 because there's 500 stocks in total that make up the index. So for those like 493 stocks, those have actually not been so loved by investors as the top 7 in the past 2 years. And there's still value in a lot of these stocks and a lot of these sectors. So if you look at, for example, the sectors that are more related to the manufacturing cycle, these will include industrial, financials.
Bonds can also help to stabilize your overall portfolio as investors wait for more clarity of the magnitude and pace of the Fed's rate cuts.
If you stay in the short and the middle part of the yield curve, that kind of offers a very good balance between yield as well as the interest rate risk. Now, what that means is that if you're locking in the interest rates that are being offered at this point of time, So even in a soft landing scenario, you would expect interest rates to come down modestly, not by a huge drop. But if they come down modestly, you have locked in a high yield, so you're getting a good income on your bond exposure. Plus, that softer interest rate environment would mean you start to make some capital returns as well in the bonds.
Still, experts caution that a soft landing is not the only possible scenario in the months ahead.
We have to keep in mind that all of this data that we get out of the US is somewhat backward looking, right? So we may not be getting a true sense of what the economic picture is at this current time. If you go back to history a little bit, actually soft landings have been very, very difficult to achieve, and it's often said, only airplanes have a soft landing, not economies really. So it is still too early to say which way we go. It will actually also depend very much on how fast the Fed can respond to these rate cuts and balance both sides of its mandate, so the inflation side as well as the employment side. If they are fast enough to cut interest rates, that can obviously help to avoid a steep recession and confirm that soft landing. But again, that comes with the risk of reigniting inflation as well, possibly. And if they are slow to respond, if they don't cut rates, we could potentially see more risks of a recession picking up from here.
More importantly, investors need to keep cool heads to ride through any upcoming uncertainty.
The key is to stay around for a long time, right? It's very hard to do when you have markets that are choppy, when when you're uncertain about the future. So some of the best strategies that we like to kind of actually advise our clients or teach our clients to do is, for example, to do dollar cost averaging. Just have a regular savings plan into an investment plan. So for example, if you have like a monthly savings plan, if the market just happens to drop for that month, you get a better deal, right? If the market's higher, you buy less of that, but just be consistent. And over time, the return will come. So I think, these are good strategies for everyday investors who don't have a lot of time to look at markets.